Barclays reported first quarter total income of £8.2 billion, a 6% increase, and announced a further £500 million share buyback, and its shares fell over 3% to three-week lows below 415p. That sequence is the opening problem. A bank that grew income faster than expected held its capital ratio at 14.1%, and returned yet more cash to shareholders should not be trading lower on results day. The bottleneck is not the headline numbers, it is what sits inside them. A $228 million impairment from the collapse of mortgage lender MFS and a $105 million motor finance provision that were not fully absorbed by the beat. These two charges together reveal something the top-line income figure conceals: credit stress in corners of the book that Barclays' own chief executive is now publicly stepping away from. Venkatakrishnan said after results that the bank will shift away from high-risk bridging and buy-to-let lending following the MFS failure. A CEO signaling a retreat from a lending category after a loss is not the same as a one-off write-down. It is a structural restatement of the risk appetite. That is what the market read. The investment bank delivered income above $4 billion for the first time in a single quarter. Strong, and it matters. But the signal investors were pricing was the credit side, not the trading side. The question the fall leaves open is whether those provisions mark the end of the credit deterioration or the beginning of a wider pattern. That question leads directly to what the Bank of England is doing today. The Bank of England's Financial Policy Committee publishes its half-yearly financial stability report today, and analysts and banks have been positioning around it for weeks. The FPC is expected to propose changes to two technical capital measures: the Common Equity Tier 1 ratio and the leverage ratio. On the leverage ratio specifically, a measure that constrains capital against total assets, regardless of risk weighting, Barclays has lobbied the most aggressively of any UK bank. Its argument is that requiring capital to be held against UK government bonds distorts the backstop into a binding operational constraint, rather than a true emergency buffer. The leverage ratio has already become the binding constraint for 3 of Britain's 7 largest lenders, as their risk-weighted assets have fallen. Citi's banking research named Barclays and Santander UK as the institutions standing to gain most from any change to the leverage framework itself, a different beneficiary profile from NatWest and Lloyds, which would benefit more from changes to how core capital is composed. The distinction matters. Barclays is not just a general beneficiary of easier rules. It is the specific institution whose constraint is the leverage backstop the FPC is reviewing. If proposals today are concrete, a reduction in the leverage requirement or the exclusion of gilts from the calculation, Barclays' binding constraint eases, and the capital it currently holds against gilts becomes available for lending or buybacks. That mechanism is what the consensus has been pricing as a re-rating catalyst. The problem is that the same institution producing this relief also issued a separate signal the day before that the consensus has not yet reconciled. On Monday, Bank of England Deputy Governor Sarah Breeden told the BBC that stock markets are too high and set to fall, that there is a lot of risk out there, and that the bank expects there will be an adjustment at some point. Breeden is not a peripheral voice. She is the bank's head of financial stability, the person responsible for the same FPC report whose capital relief the banks are anticipating today. Her remarks named 3 specific concerns: overvalued AI equities, private credit systemic risk at scale never before tested, and the likelihood of multiple risks crystallizing simultaneously. The tension is not superficial. The FPC today is simultaneously telling UK banks to hold less capital as a backstop against losses, and its own deputy is warning publicly that a sharp market correction is a base case expectation, not a tail risk. A bank's leverage ratio relief is most valuable in the exact environment where that relief is least safe to deploy, when asset prices are elevated and credit exposure is building. Barclays' own market sent a reinforcing signal this week. A $960 million leveraged loan it was arranging was pulled after weak investor demand. A leveraged loan failure is not a Barclays credit loss, but it is a direct read on institutional risk appetite for the category of lending Barclays Investment Bank originates. The fee income evaporates, and the signal it sends about credit market depth sits precisely in the gap between the regulatory optimism and the trading reality. The consensus assumption embedded in the capital relief trade that freed capital flows into earnings accretive deployment requires a credit market willing to absorb that deployment. That assumption is the one Breeden's warning and Barclays' loan failure both challenge, from different angles with concrete evidence. The report itself is the verification event. If the FPC proposes concrete leverage ratio relief today, specifically an exclusion of UK government bonds from the calculation, that removes Barclays' binding constraint, and the capital release is real and near-term. Against a CET1 of 14.1%, already above the top end of its 13-14% target, a leverage ratio change would accelerate buybacks and lending capacity. That is the condition that turns the Q1 share fall into a mispricing. The market penalized the credit provisions without pricing the regulatory catalyst arriving hours later. The counter condition is that today's proposals are marginal or deferred, language noting consultation timelines stretching into 2027, or recommendations that stop short of gilt exclusion. Analysts already describe changes as likely marginal, but on balance helpful, a qualifier that, in a market where the BoE deputy was warning of a crash yesterday, converts helpful into noise. Holders should watch whether the FPC's language specifically addresses the leverage ratio binding constraint, not just the CET1 benchmark. The latter was already lowered to 13% in December, providing limited incremental relief. Watchlist candidates should watch whether Barclays trades back above 430p on the FPC announcement, a level it held before the Q1 result, as the price signal that the relief outweighs the credit concern. Below that threshold after the report, the market is telling you the MFS and motor finance provisions are the leading signal, and the buyback is being discounted because the capital may be needed for further credit losses rather than return to shareholders. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.